I'm about to teach you the most important form of technical analysis that's overlooked by 95% of retail traders out there. This strategy is super simple, super effective, and it's only going to take you one video to understand it. Let's get into it. So let's talk about what you're going to learn in this training. I'm going to teach you how to correctly identify the Forex master pattern and actually map it on your own charts. Now, for those of you who do not know what the Forex master pattern is, this is the most consistent form of technical analysis. It works on every time frame, on every currency, and it doesn't only just work in Forex, it works in stocks, works in commodities, it works in any financial market, even cryptocurrencies. So it's super, super important that you at least know about this pattern whenever you're doing your technical analysis. This will allow you to break down the seeming randomness of the market, and you'll be able to classify each movement as within a defined phase. So no more randomness. Everything has a purpose and a story behind it. You'll be able to connect that story together. The correct mapping of this pattern will help you understand the market from the institutional perspective. This pattern is actually the footprint that is left behind by the bank's activity and how they do business. So you're not going to be looking at the market from a retail perspective with your indicators, your moving averages, your MACDs. You're going to be looking at the market from a money flow perspective, from how the institutions have to do business in order to create and facilitate the liquidity that they need to move their money around for profit. So this is something we've studied at Trade ATS for over 10 years. We know what we're talking about. We've trained hundreds of people on this exact pattern. It has a long history with what you're going to learn here. And this kind of information usually costs thousands to learn, and we're going to give it to you for free. We do have products and things that you can go look at on our website, but you do not need those. Everything that you learn in this training, you can go on your charts, you can do it for free. It's just straight up good information. It's the information that we wish we would have had when we first started out. So here it is for free. We ask nothing in return. So this is a basic model of the Forex master pattern, or what we also refer to as the three market phases. The first phase is contraction, which is a tightening of price. The second phase is expansion, which is the opposite of contraction. It's a widening of price. And then phase number 3 is the trend phase, which is the inevitable move to higher or lower prices in a falling market. One thing that I want to make crystal clear is that this pattern and the understanding of this pattern is not something that's proprietary to us at Trade ATS. You can learn about this in a number of other places, but the origination of this happens to go back all the way to the early 1900s with traders like Jesse Livermore and Richard Wyckoff. They're really the earliest known traders that started unmasking this behavior, putting framework to it, and a logical explanation with how to interact with it. Since then, there's been many traders that have adopted this and come up with their own explanations of how to interact with that. And anybody talking about how the banks control the markets and how to follow the banks, I would suggest that you take what they have to say and at least listen to it, because I'm sure you'll gain good knowledge nuggets from anyone who's talking about this. But what I want to make clear is that this is our take on it, based on over 10 years experience, and what I'm going to tell you in this training is how we feel is the best way to understand and interact with it. That's all. I just want to make that clear. So that being said, can you spot the master pattern in these series of candles? Well, it all starts with the contraction phase. Where is that? Right here. That provides us with our market maker balance point. This is the point that they balance their book of business. Out of that contraction phase, we have the expansion phase, which is the widening of price. And then we go into the trend phase, where they actually make a move to higher or lower prices. In this example, it goes to higher prices. Now, we've made a video that goes over the general strategy and understanding of this pattern. If you haven't watched that video yet, I would suggest you go through our channel and go back and watch that video after this one, because that'll really expand on this general pattern. But with that video, through our comments on YouTube and the emails we've gotten, people had one major question with identifying and interacting with this pattern, which was, how do I accurately draw a contraction box? How do I define the all-important contraction zone? Because that is where it all starts for identifying this pattern. So, like I said before, it all starts from the contraction zone, and that's what we're going to teach you how to define here. And I'm going to take a few minutes and explain the significance of the zone. This is a defined balance point on a chart where the market maker has conducted an equalizing two-way business between buyers and sellers. So what creates this box or these zones is the dynamics of the type of business that is being done. You could think of this zone as kind of a reset point for the market makers and the large institutions. In this area, market makers can evaluate supply and demand, which allows them to create a portfolio management plan. Remember, they're moving around huge amounts of money. When this market pause comes into effect, things are temporarily balanced out. They can assess supply and demand and figure out what their next move is. What is most important is accurately defining these areas on your own chart and then using them to map out the true framework that the market will respond to and obey. So as you get series of boxes on your charts at different price levels, you're going to notice that this creates a framework that the market responds to in an extremely accurate way. And then through those series of boxes, you'll actually start to unfold the story of the market and what's going on behind the scenes. That's why these contraction zones are so significant to really get down and understand. Okay, so now let's get into the nitty-gritty of how to actually define these contraction zones on your charts. So the main characteristic, this is a leading indicator, the main characteristic of the contraction zone is simultaneous lower highs and higher lows. So literally a tightening or contracting of price. It's pretty simple to see. It takes a little bit of practice, but once you start looking for it, you'll see that the price constricting. And that's your clue that you're going into the contraction zone. Now, there's also a lagging component that confirms that gives the ultimate confirmation that this zone is valid after the contraction, and that is the expansion phase. So those expansion legs, expanding high and expanding low after that box, basically confirm that was a valid contraction point. So in a sense, they point back to the contraction zone as well. So you may be asking, isn't it too late to identify a contraction box by its expansion phase? Wouldn't this be totally, unusable information? The answer is no. There's countless situations where the market forms 3 or more expansion legs, some 5, 6, 7 expansion legs back and forth, where you would want to use that original contraction zone as a reference point. So, no, this is definitely not late in a lot of circumstances. So this not only gives you time to discover trading opportunities, but it solidifies solid points of market architecture that become key levels later. It's all part of the framework that creates the real market architecture. So let's briefly take a look at an example here. This is the global master pattern view, okay? So we have a first swing high. You see, we form a high here, and then it's followed by what we call a swing low. So this is your first clue that you could be going into a classic expansion pattern, something definitely to keep your eye out for. You notice that we go up, we have another swing high, which is passing the previous swing high point, followed by another swing low. So you can see how price is starting to funnel out and open up here. And then we have another swing high, okay? Now, what you need to get from this, and it started with the first swing high and swing low point, that all of these high and low points point back to one central point, and we call this the point of origin for this entire move. So you want to constantly be scanning your charts for those contraction zones. Number 1 being with the contraction of price, that's your leading indicator, and then your lagging indicator, number 2, would be the first expansion legs. You expand high, expand low, or expand low, expand high. Doesn't matter the sequence, but that's what points back and solidifies that level as a key level that the market makers are using to balance their book of business. Now, as you track these zones, you're going to get more of them, and as you get more of them as price flows, you're going to see that it starts to paint a picture of a map-like structure. And it's giving you all these, the major and the minor key levels that the market makers are using to manage their book of business. And you'll notice that they all work together to tell a story. And when you figure out what that story is, you're going to have a much better sense of what the market's likely to do. And better yet, you're going to have static horizontal lines to manage your trades by and control your risk with, which it doesn't get better than that. So hopefully at this point you're starting to see just how important it is to effectively track these contraction points on your charts. So back to the question that we're repeatedly asked through email and on YouTube is, how do I find the Forex Master pattern on my charts in real time? what I'm going to do now is I'm going to take you to the live chart, and we're going to do some live analysis and find these contraction zones and start mapping the market. So you'll learn to do that here in real time. Okay, so now we're in the charts here. So the first pair I'm going to be looking at, we'll go through a few of them, but we're going to start with dollar CAD right now, and we're right up till the previous moment. We don't have any price data right now because literally the markets just closed for the week. I didn't get around to do this while they were open, but that doesn't matter. We're still dealing with relevant market information, here. So that being said, when you're looking for the contraction zone, what's important, it's not important that you find every single contraction zone on the chart. You don't need to draw boxes all over the chart. What is important is that you draw boxes at the correct places that are relevant to where price action is, at the moment. Where is the live price, at that moment, and what contraction zones and average prices are relevant, to where you're at there. So that being said, what we're going to do, I have the daily, I got the 15 here. I'm going to go over, we'll start on the higher time frame, which is the daily. And if you haven't used MetaTrader 4 much before, I'm going to actually give you a little bit of a tutorial here. I'm going to show you how to actually get a box, if you've never done it before. You go up here to insert, up here at the top, and you go down to shapes right here, and you just grab a rectangle, and then you can just drag and drop the rectangle wherever you want on the chart. You could double click on it. You click the little middle dot right here. You could drag it around, and then you can resize it from the corners. And when you're done, you could double click it, again on the middle dot here. And then that'll pretty much kind of cement it in place, and then just double click it. You could resize it, do whatever you need to do. So that being said, we have a box here. So this is the daily chart. You can see the dailies, it's ran down, it doesn't take a rocket scientist to see that. But where is that contraction period? Okay, where's the most recent spot that price really tightened up, that we can see? Well, just glancing over the chart, remember, you don't need to make this too difficult. But glancing over the chart, I see we pushed down right here, and we had this blue candle, yellow candle. I can see that the price got pretty tight right here. So that would be, in real time, that would be your first indication that you want to start paying attention to that point, as price is forming. But what's even more important after that is see how the expansion legs came out of this. You expanded down here, went below the low, then expanded up past the high right here. See this kind of unwinding of price going up and down? These highs and these lows coming out of here are pointing back to this as a central point. So that would be a safe place to recognize as a market maker balance point. So we would take our box, we would stick it back there, and I would basically just go off of the low and high right there inside the box. That would be a really good place to mark as a contraction zone. So we got that in there, and then what you want to do is you want to come up here and go to insert. Actually, I'm sorry, I take that back. You want to go over here and just grab a line. Make sure you have the chart highlighted. Click the line tool right there, and then go down, and then you'll stick a line out. And then you can double click on it here if you need to move it around. You'll get these little boxes at the edge. And then you want to stick a line right there just in the middle of the box. So on the daily, on dollar CAD, that right there is your sensitive price level. You can see that we're well below it right at the moment. But basically, what you the information you can get from this on dollar CAD right now is that any more yellow candles that form below this level, right now you're going to want to trade short. If price pulls back all the way back up to here, then if we get above, then you'll probably want to start trading that long. So, but that is your sensitive point. The real opportunity on this particular pair was right here when you had this rotation. You'd see the price whipped back and forth out of that. And we really knew about the contraction, and it kind of confirmed itself once we had these first two expansion legs come out of here, expand high, expand low, and then that pointed back to this being the really sensitive contraction point. So as that came out, you had this run up, it had a aggressive drop down, the price moved up, and that's that settling that we talk about in the other master pattern video. That happened right there. So this first rotation off of that is really the sweet spot. When you want to start looking for your optimal trading opportunities on the lower time frame. You want to be careful as it goes farther and farther. It doesn't mean you can't trade it. You can still trade it if you want to, but remember that the trends will end at some point. So you don't want to see something that's ran away from that sensitive expansion level and gone down and down, for 2-3 weeks. Sometimes they'll trend You don't want to get it when it's already paid for a long period of time. The sweet spot is figuring out what's going to happen in and around that sensitive point. So, I'm getting a little bit ahead of myself there. So that's it on the daily. That's really all you need to do. You need to find that last relevant, contraction period. Sometimes we'll find more, but we'll do that on other pairs here. So we got that on the daily. That's our relevant point we want to use. Now on the 15, this is your actual trade placement. This is where you're going to find a strong entry position. So going off what I just said there before, there are a number of contraction points, but going from the leading indicator, which is the tightening of price, and then the lagging component, which is those first two expansion legs, I see it in here. You see this push down right here, and then this push up. See how price got tight, and then it was led by, and it expanded past the low, and then expanded past the high. So you have the tightening followed by the opening. So that points back to this right here is the most recent sensitive point, the main ones you're going to want to deal with. We did have another one that looks like right here, a minor contraction point. It went high, went low, price tightened, then we expanded high and expanded low. So you can use this one or you can use this one. Either one of those is going to give you relevant information to deal with this entire area right here. So what I'm going to do, I'm going to use this one right here, because that one is, we're still relatively close to that, where live price action is. So I'm going to go over here. I got the chart highlighted. I'm going to go to insert. I'm going to go down to shapes. I'm going to grab a rectangle, and then I'm going to go ahead and stick that rectangle, right here. I'm going to go off of the low, of this previous yellow candle and the high of this blue candle right here. So let me resize this a little bit. And just like that, I'm going to use that as my contraction zone. Then I'm going to go over here and grab my line. I'm going to stick my line right there in the middle of that box. And there you go. There's your sensitive price level. Now look at painting forward. You could have suspected this as being, in real time. When you saw the price contract like that, you could have suspected that this is going to be a significant level for the market makers and the smart money. But again, what really cements it in is that the following expand low, expand high. That points back to, yes, this is definitely one that we want to look at. And you'll notice that with that expand high and expand low, expand high, we're still dealing in this price action range. And that's what I talked about in the presentation. Is this too late? You could see that no, even with this, this is actually excellent timing, because number one, you've defined the contraction zone point, and you've also missed two legs of whipsaw action. And this kind of action destroys traders when they don't really understand what's happening there. So you've defined the point, and you've missed the death blow that most people get involved with. And now you have this exact line to define your buying and selling. See how it got real reactive at that point here? And how this move starts to mature. Swing low, swing high, swing low, swing high. Eventually, it's going to stop breaking the highs and the lows, and you're going to get a significant deviation away from this price. See how it came down and it held that exact price? And then that rotation right there? That's really what you're looking for. Because if you sell that market right there, your downside is just basically right here at this average price. And you're not guessing here. That's what I really want you to get from this. You're not guessing. The price action has confirmed this. You're letting the market tell you the sensitive price level. You're not going to impose your thoughts and beliefs on the market. This all happened, and it formed in a very simple way to define. And what goes on with the price action is it continues to respect that level, because it is one of those sensitive levels that you can use for a consistent analysis. So, anyway, I don't want to get too much on a tangent there, but what I'm saying is that the market, when you do it right, you'll notice that especially as you get multiple expansion legs, the market continues to get sensitive, almost to the pip usually, of that exact level. And then the more sensitive it is, the more this is something I really need to trust in the future, and I need to look at where is that price settling, and then you combine this kind of information with the information that's probable to happen over on the higher time frame, and then you have an extremely effective price level to come up with different trading ideas and management points. So anyway, that's it. You want to find that last one to deal with. Another one that I see in here, see how we pushed it? We pushed up long. It didn't really go past the high. We pushed down low. This was a potential contraction point. And all contraction points carry some significance, but the ones that form multi-leg expansions are the most significant because that's the market makers defining their dealing range. But every time you get a contraction, there is that two-way equalizing a business. So you could, if you want to get more perspective, it could be as simple as this. Literally one box here, the most relevant you could find. Doesn't need to be perfect, but the most relevant on the higher and the lower time frame. That's where it starts. But if you want to get a little bit more of the picture, you can go ahead. I see that there was a good contraction here and also see that this respected that contraction point. So what I'm going to do, just for the heck of it, I'm going to go over here to insert. I'm going to go down to shapes. I'm going to grab another rectangle and I'm going to stick the rectangle on that high and that low right there because I know that that was a sensitive level. And I see that the market had already interacted and reacted to that level. So I'm going to grab my line, stick my line right here in the middle of that box, and there you go. So now I have two levels. I have a dealing range between two sensitive price levels that is going to help me understand probability. If the daily is going to continue to trade short, let's talk about scenarios now. This was a potential entry point, rotating short off the daily. We're hoping that the next candle is yellow at that point, headed down, right? If that's going to happen, now you have some architecture to start asking yourself questions. If the daily's going to continue to trend short, what needs to happen on the 15-minute time frame to confirm that trading idea? Well, number one is we would like to see, because this has been respected, we would like to see price hold below this. That would make sense, right? So if you're going to sell the market, you're a little bit a ways away from your danger point. This is kind of the point of definition of no return, right? Where the idea would be considered to not be working out. It may get noisy here, but if it gets much above there, then, you may be headed in a long trend, right? So if you enter right now, when you're calculating your risk to reward and you're coming up with what makes sense financially to approach this opportunity, you have this level now, and you know that you're so far away from it. It's a hard level, not an average, so you can figure out your position sizing, figure out, what you're going to do for risk based on that level. Now, if it's going to really come around and keep pushing, then your potential target, just generally glancing at this chart, I would expect that you'd want to see that you would at least test this low right here. And when you test it, hopefully it breaks and snaps it hard if you're trading the short trend, right? But on the smaller time frame, if you're entering somewhere in here, ideally it would have been up here because then you're tighter to your risk, and you have this level of architecture here, you see that it's respected it, then you can see that initially for the progress of this idea to work out, that you really need to get through this level, don't you? If this is going to pay you on the daily, remember the trade is the daily, if that's going to pay you, you really need to get below this level. So this would be your initial, I'm not going to say profit target, I'm going to say progress target. This is where you need to get to know that this idea is valid, it's making progress, and by the time it gets here, you know that you're already in the money, and once you get in the money, now you have some choices as far as, how much room you want to give the trade. When it gets down here, you're in the money, and you can say, I'm expecting that I'm going to get a hard break past this low and be well on my way. And then if it does get past that low, you're expecting that you're not going to come up above this level. Because if the trend kicks in, you'll notice as you come through expansion levels, it starts to respect them in kind of a stair-stepping fashion, whether it's going up or down. You'll want to see it respect that level at that point. And in that point, you have the profit from your entry to that progress target locked in, and now you're in for the ride. So, that's your relevant, analysis for USD CAD right now. This is relevant to use right now, as we go. The only thing I don't like about it, remember, this is just for educational purposes, but the only thing I don't like about it is that really the ideal entry points were up here. You really want to reverse engineer the trade from your higher time frame. You almost want to be, you can approach it this way. When you almost just want to jump in on your higher time frame without looking at a lower time frame, that's the time to start looking at the lower time frame. It's not the opposite. because really this right here, that was the driving move of the trade. And that respect of the expansion level right here, that the market maker average price, that really was the best clue right there with the lowest risk. If the daily paid you, which it did off that level, you're immediately in the money. If you're wrong, well then you get stopped out right above it. No big deal. Big upside potential to downside at that point. We're far away from that point now. So again, doesn't mean you can't still trade it, but you gotta keep in mind where you are in the cycle. Eventually all trends come to a stop, and at that point you'll want to wait for another box and then restart this process. But remember, that is the sweet spot. And if you really want to trade safe, wait till this opportunity comes to you. There's nobody holding a gun to your head saying that you need to make the trade. Wait for this opportunity to come to you and then take action. If that opportunity isn't happening, then wait, because it does happen all the time. Alright, let's scan some pairs and see if we can find anything interesting. And in fact, we're not even gonna mess with the 15 at first. Let's just look at the daily, because remember, the daily's really the trade, and this goes for whatever you're using for your higher time frame. In this case, we're just using the 15 into the daily, so let's just go from the daily chart first. So pound USD, we'll go to the top list. I don't see anything great. We're kind of extended on the daily. Could be new, but nah, let's find something better. Aussie dollar. Starting to already run, maybe another leg in it, maybe better on your lower time frames, stuff going on there, but nah, I don't see anything great on the daily. Bitcoin, interesting things coming in right there. We're starting to come, you can see we're just in this overall, tightening range right here, so, starting to break out of that. Could be some interesting things going through there, but, I think we find something better. Euro dollar. Definitely nothing there. Already done. The range already happened in here. The entry point was coming out of here. Not good for doing any analysis on that at the moment. Dollar franc. Same thing. Nothing. Garbage. Dollar yen. Little better, but already had a breakout. Let's see if we can find something better. Euro franc. Nah. Good next. Euro pound. Huh. Okay. So this is interesting, just from what I'm seeing right here. So let's take a look at a euro pound. Okay, so if the trade starts on the higher time frame, where do we need to start here with euro pound? We need to start on the daily chart. So where do I see, based on just glancing on of what's going on in this dealing range right here, where is the best place that we can spot a contraction zone that would serve to be a good reference point for what we're dealing with right now? I see it's pretty clear as day, so I'm gonna grab a box, go up here to insert, shapes, grab a rectangle, and I see we push down right here, didn't pass this low, we tried to push up, didn't pass this high. I see a tightening of price, which is that first leading indicator, and then the lagging indicator, we broke the low, trend didn't continue, we whipped back up, broke the high. So this low and this high point back to this zone right here. Now, why this zone is even more interesting to look at, why is that? Think about it for a second. What's happened in recent history right here? Literally 1, 2, 3, 4 days ago. I'll tell you what happened. Let's draw our line here. Didn't we respect that right there? That level? So you knew about this contraction zone. Let me adjust it just a little bit. I think that's good. Okay, you knew about this when you had your expand low, expand high. Basically, the minute you snapped this high over here on this daily, you knew that I need to pay attention to this, right? As you came up, came down, respected it. Remember on the last one I said, where's that sweet spot? There it is. So the ideal trade placement on this was right here. That's your ideal spot. But this is still pretty early, and that's a pretty powerful signal. That's when you get that blatant respect of that level, what that signifies is the potential that the market makers are done dealing in this range. They're done with the whipsaw. They're saying, nope, we're gonna protect our average positions that we paid in this dealing range, and we're gonna move the market. Does it always have to happen perfectly that way? No, it doesn't. But again, you can wait till it does. That is up to you. No one's forcing you to trade. So we have a pretty clear as day clue right here, right now. So I think that would be safe to go off of on the daily. And we're only 4 days into the run, and you notice that we really haven't snapped the active high, which is right here. if this does continue to run, we can get a significant move past this high and up past this high. Does it have to happen? No, but it is a good place to start for formulating a trading idea and a trading plan associated with that. Okay? So that being said, let's go over here to the 15-minute. What is relevant? I see a couple things going on in here, but what's relevant to price right now? Right now where we are. Well, let's look for where do we get the initial contraction and where do I see expansion legs happening? That's going to be the most sensitive point to start with. And I see it. Let me expand this a little bit for you. I'm going to go ahead, I'm going to grab a box, and I'm going to show you where it's my opinion. Maybe you have a different opinion, but this is where my opinion is that as a position we should be tracking. This run pushed down, didn't pass the low, pushed up, didn't pass the high, price contracted, leading indicator, lagging indicator, broke the low, broke the high. Same thing that happened over here, right? So I'm going to take the high and low right there, and I'm going to use that as my center, or as my contraction point, and also I'm going to use that because price is there right now. It's getting hung up on that expansion level. I'm going to get my line tool. I'm going to drop that in right there. Move it, get it adjusted right in the middle of the box there. And there you go. So now for this trading idea, let's say that your idea now is because we have this clue combined with the price action that's going on the 15, a reasonable trading plan for this. We have a multi-leg expansion that's happened here. If you get a significant momentum push now up through this level, you notice that these pushes didn't make it, but right now we're playing with that level. If you get above here, and would it be safe to just jump into a long trade right here, in line with the trend on the daily, which is backing up the idea? And the answer is yes, because you have this reference point. Market makers have proven this is their dealing range. If it wasn't their dealing range, we would not have a multi-leg back and forth, expand high, expand low points coming out of this. They wouldn't have defined the range. They defined it. We're just dealing with their rules, right? So as price goes up through here and begins to hold above there, this is a safe place. I'm going to give you this. This is a trading idea. Disclaimer, you make your own trades. You guys do what you want. You invest as you want, but I'm just giving you my opinion here. You can buy right here if you want. And you can protect your risk below this line because it's defined as a sensitive price in trend. You could see that it's been respected as he pulled up. See how it bounced off that level here? Came down, got through it, bounced off the level. Right there. This is the point that is very relevant for where we're at. So if we get above that, you can jump into that and then just understand that if this is really going to make progress, then as price gets up through here, you get full candle bodies above that. It would make sense that price really wouldn't want to go much below that level anymore. And that you would be going, where would your initial progress target be for this specific situation? Not your profit target, but progress. When do you know that you're really making significant progress? And I would reference back to the expand low, expand high points. Expand low, expand high. Expand low. Where's expand high? If it's going to go, it's right here, this very top right here. So that would be your progress target. And if you want, go ahead and grab a line and stick your line right there on the top. So as you enter the trade right here, you know that we pretty much need to make, relatively immediate progress up to this level to really feel good about this opportunity. And you would protect your position down below. Now, if you don't get up here, if it respects this and turns and starts heading short, what does that tell you about the potential future of that daily candle? It tells you that we could be headed for a yellow candle and that this is not quite ready yet. Either way, you're at the point. You're at the level. You're gonna know wherever it lands on either side of this level. There's a good chance that that's a defining point, long or short. And it's going to help you predict the future of the daily. The daily helps you get the probability of the trend sustaining, and the 15-minute helps you predict the potential future of the daily. They work together. And you have to weigh them out together to figure out what's the true, plan of the market makers. How are they going to make money? And when you accurately define these tipping points, then that is where you're going to really start to understand what the potentials are. And more importantly, instead of using moving averages, using all the other indicators that lag when the trades are already turned against you or it's not going your way, this is a defined price level here. This is a hard price. It's going to be much more accurate. The horizontal lines are going to be much more accurate than just trying to work off of flowing averages. So, anyway, that's it. So that would be euro pound, and I think that's what you need to work at, and that's your sensitive price level, and that would be your initial progress target. And you would just wait till you get above that, pull your trade, protect your risk right below. And if it doesn't go above that, I probably wouldn't trade it short. I would still stick with the uptrend. I would just give it more time. It might go sideways. And then when it goes above, then hit it there. Don't force it. You don't need to force it. You let the trade come to you. Nobody, again, there's very few things that you can control as a trader. You can't control when the market moves. You can't control how much it moves, how far it moves. What you can control is the opportunities that you interact with. It's 100% in your control. So since that is in your control, and that is a very powerful thing to control, you have a choice to interact with opportunities that are only the finest opportunities, that make sense not to someone else. You don't want to take tips from someone else. They need to make sense to you, because you are the one that's going to have to manage through the trade. So make sure it makes sense to you. Make sure that you see the story is clear, and that you've defined accurate contraction points to start building your map from. And then when you feel that you've gotten a good sense for what's going to happen and it's not too late to the trade, it's time to get aggressive. So that's it. So hopefully that helps with you guys defining contraction points.